It's Wednesday, November 15th, 2023. Let's talk about the news. From Bloomberg, key Fed inflation measure rises at slowest pace since 2021. New inflation data released yesterday indicate that consumer prices in the United States rose at a slower than expected pace in October, and that led to a surge in stock market activity around the country and in connected global markets. This is broadly being seen as good news for the U.S. Federal Reserve, which is tasked with pulling inflation down to something close to 2%, and for U.S. residents who have struggled with high inflation rates for several years. Overall prices rose 3.2% in October compared to the previous year, which is down from September's rate of increase, and core prices, which exclude more variable and volatile food and energy numbers, rose 4% on an annual basis, which is the smallest increase since September of 2021. This is a more favorable bundle of data than most analysts were predicting, even at their most optimistic, and it's generally assumed that this means the Fed will keep interest rates steady at their next meeting in December. From the Financial Times, Exxon to begin producing lithium to feed surging battery demand. In what's being seen as a substantial strategic pivot, ExxonMobil has announced that it will begin producing lithium for the burgeoning electric vehicle market from underground sources in Arkansas, beginning in 2027. Many oil majors have gestured at getting involved in renewable energy infrastructure over the past handful of years, but this effort, unlike investments in carbon capture technologies and hydrogen, is not dual use with their existing fossil fuel business, which suggests Exxon may be starting to map out in earnest a segue toward renewables, hoping to scoop up valuable assets before other energy companies can do so. That said, this follows another massive investment by Exxon in Pioneer Natural Resources, which is a huge Texas-based oil producer. So while this is a foot in the EV market door for the company, it is far from a wholesale shift in focus. And from the Wall Street Journal, Chrysler parent Stellantis prepares to offer buyouts to U.S. salaried workers. The parent company of automotive brands like Chrysler, Jeep, Ram, and Dodge is reportedly offering buyouts to about half of its US-based white-collar employees as part of an effort to cut its expenses as it recalibrates toward an EV-focused future. This marks the second round of buyouts the company has offered this year, and it's expected to encompass around 6,400 non-union workers with at least 5 years of experience. Other U.S. car companies like GM and Ford have also cut their ranks of salaried employees over the past year, and these cost-cutting efforts are being seen as a response to higher costs associated with EV R&D and battery manufacturing, alongside concerns about higher factory worker costs and the potential for an economic downswing that could truncate sales.
If you're finding some value in One Sentence News, consider leaving a quick review wherever you get your podcasts and/or sharing the show with a friend. You can find out more about this show or subscribe to the email version at onesentencenews.com. And you can support this and other related projects, like the Let's Know Things and Brain Lenses podcasts, at understandery.com.